Welcome to the Explainer. Today, we're talking about one of the most important numbers in all of finance, one that acts like a report card for your money. It's called yield, and we're going to break down exactly what it is and how to read it.
It's the biggest question, right? Whether your money is in a stock, a savings account, or maybe a new business project you're funding, how do you really know if it's doing its job? Well, there's one key concept that gives you the answer.
Okay, that sounds super official, I know, but in simple terms, yield is just the return you get from your investment. Think of it this way. For every $100 you put in, how many dollars are coming back to you each year? That's your yield.
And honestly, that report card analogy is the best way to think about it. It's this single, really powerful number that grades how well your assets are performing. Is your money an A-plus student, or is it kind of flunking out? Yield is what tells you the score.
All right, so here's our game plan for this explainer. We're going to start with the basics, then get into the language the pros use, see some real-world examples, zoom out for the big strategic picture, and finally talk about how you can actually put this all to work. Let's dive in.
First up, let's really get to the heart of why yield is considered such a fundamental core metric in the first place.
This right here is the key insight. Yield isn't just some flat number, it's multidimensional. What does that mean? It means it tells you a story, not just about how much cash you're getting back, but also about how much risk you're taking on to get it.
Okay, so we've got the what. Now, let's learn how to speak the language because how yield is expressed is super important.
Now, this is a critical distinction you have to know. Gross yield is that big, flashy headline number. But net yield, that's what you actually get to keep after all the pesky costs, fees, and taxes are taken out. That's the number that really, truly matters.
You'll almost always see yield shown as a percentage. And there's a good reason for that. It's the great equalizer. It creates a universal language that lets you compare completely different things, like a real estate investment to a government bond, totally apples to apples.
And when you're talking about huge sums of money, even the tiniest changes can make a massive difference. That's why financial pros often talk in basis points, or just bips for short. So a jump from 5.25% to 5.50% isn't just a quarter of a percent. It's a 25 basis point move. It's all about precision. All right, enough with the theory. Where are you actually going to run into this stuff in the real world? Let's look at some of the most common places you'll see yield in action.
If you're a stock investor, this one is huge. The dividend yield is basically the company sending you a little thank you check out of their profits, just for being a shareholder. It's your direct slice of the pie.
Now, this one you have definitely seen before. Whether it's the interest on your savings account or the return from a bond, this is probably the most common type of yield out there. It's simply the price someone pays to borrow your money. This one's a bit more of a pro-level tool, but it is so powerful. It takes that famous price-to-earnings ratio that everyone talks about and just flips it upside down. It gives you a fantastic snapshot of a company's profitability compared to its stock price. A really high earnings yield can be a huge signal that a stock might be a bargain. So what's the big takeaway from all this? It's that you need the right tool for the right job. Different assets tell different stories. And so we use different types of yield to understand them, whether it's about getting a share of profits, getting paid for a loan, or sizing up the entire market.
Okay, so we've been looking at individual investments. Now let's zoom out. Let's pull the camera way back, because yield isn't just a metric, it's a tool for seeing the entire economic landscape.
That's a huge question, I know. But in a very real way, yeah, it can. In fact, one of the most watched financial indicators on the entire planet is something called the yield curve. I know yield curve sounds kind of intimidating, but just think of it like an economic weather forecast. Its shape tells us what the market thinks is coming. And when the curve inverts, meaning short-term bonds start paying more than long-term ones, it's historically been one of the most reliable warning signs of a recession on the horizon. On a strategic level, this is the classic trade-off every single investor faces. Do you go for high-yield stuff, chasing those bigger rewards but taking on way more risk? Or do you play it safe, choosing the stability and predictability of low-yield assets? It's a constant balancing act.
All right, last section, and this is really where the rubber meets the road, because yield isn't something you just look at passively. No, it's an active tool you can use to make smarter decisions.
Look, the pros don't just sit around and hope for a good yield. No way. They actively manage it through a process called yield optimization. It's this disciplined cycle.
You set a target, you measure your performance, you manage your risks, and you're always looking for ways to nudge those returns just a little bit higher.
And a really savvy investor always digs deeper. They ask, okay, where did this yield actually come from? It's so important to separate the sustainable, core yield from the main business, from those one-time gains like selling off a building. The core yield tells you about the real health of the company.
And really, this is what it all boils down to. Every major investment decision needs what's called a yield justification. You have to be able to answer the tough questions. Is this potential return really worth the risk I'm taking? And does this even fit with our overall strategy? That's the final gut check.
So, yield is an absolutely fantastic report card for your money, for sure, but it doesn't tell you the whole story. It measures the return, but it might not capture the full picture of risk, or the ethical side of an investment, or how it fits into your long-term goals. So, my challenge to you is this. The next time you see a yield figure, don't just take it at face value. Ask yourself, what's the real story here? And what is this number not telling me? Thanks for watching.